but that's not my intention here. I have it condensed down and kind of, here are some key things you need to know. Of course, there's a lot more to this than what's here. It affects everybody. Whether you're a corporation, individual, your pass-through entity, every single business and individual in the U.S. is changing. Some will see huge breaks, some won't. So it's just going to kind of depend on how things fall together. So it's important to understand what the changes are. So we're going to start with individuals. So I'm going to do it this. Just click the over button on the slide. No, you're okay. I'll wait till she gets back because it's not working. It's fine. I can talk about it from my handout. So the first thing that we're going to talk about is standard deduction has completely gone up. So if you're single, your standard deduction is now $12,000, and if you're a married filing joint, it is $24,000.
What was it?
It was like $6,000 and like $10,000. So it doubled, give or take, you know, inflation on a year-to-year basis. So that's huge for planning because if you're taking the standard deduction, your state taxes plus your medical plus your donations aren't exceeding either the 12 or the 24,000. So with the standard deduction going up, they have completely phased out exemptions. This is a big deal for people who have lots of kids or taking grandparents or anybody that they were taking an exemption on. Whereas before you would get an exemption for you, your spouse, and your 2 kids. Now that number is 0. So yes, standard deduction is up, so you'll get a bit bigger deduction if you didn't itemize above that line, but no exemptions. So that's one big, huge change. The child tax credit has increased. So if you have kids under 17, you will get a little bit bigger child tax credit. But there are some stipulations. You have to absolutely have a Social Security number for the child tax credit. Otherwise, they won't allow you to take it for kids under 17. So the numbers are $2,000 per child under age of 14, and the $1,400 the refundable credit. So that means you get a credit on refunded, which would be on top of it, like reduces your tax basically. And then they increased the phase outs for the child tax credit. So now it's $400,000 for married filing joint and $200,000 for everybody else, which would be usually like head of household because you would have kids. So if you have grandma living at your house or your parents living at your house, you don't get an exemption for them anymore. So what they've done now is they've added a $500 credit for somebody like that. And that's available, as long as they meet the dependent rules, same rules apply, they can get the $400 credit. So that's a nice to have, but it's not necessarily a one-to-one from the $3,500 exemption to the $500 credit. It depends on kind of what your tax bracket is.
What's the difference between the $2,000 and the $1,400? What's the difference? There's both?
Yes. So $2,000 is the total credit available, but only $1,400 is refundable. So if you don't make over a certain dollar amount, you won't get the full. You don't get all $2,000. You get $1,400, but you don't get the additional $600. That's only for working families piece because it's a credit. It's not refundable credit. So I can show you on the form where it goes, but it goes in 2 different spots.
If your income isn't to a certain threshold,
right,
then they're not going to give you money back unless you've made a certain amount.
Right.
They're not going to credit you.
Exactly.
I think it makes sense now. Okay.
So you can still get it, but you just don't get as much. Itemized deductions, there were some changes to that. The medical deduction threshold is the 7.5% of AGI. There was a time where it was over 10%, so this is nice because it's the drop-down number.
This is what you have to spend before you can get
Yes.
any kind of deduction.
Exactly, perfect. That's a great question. So for medical on your Schedule A, which is your itemized deductions page, you have to exceed a certain dollar amount in order to qualify to take the expenses. So let's say your deductible for your medical is $10,000 and you have to exceed 7.5% of your AGI in order to take that expense. So some people, the threshold is small and some people it's big. So it just depends on where your adjusted gross income is. The state and local taxes is a huge change because now you can only take up to $10,000. That is your property taxes plus your Minnesota state taxes plus the ad valorem taxes on your vehicle. So all of those together. If you're in a state with no state taxes, then it would be sales tax plus property tax plus the ad valorem taxes. This is a big deal because this is where a lot of people were able to itemize before. So it's nice that the standard deduction has come up because now you hopefully will get the same benefit. The states are very unhappy with this provision. Some states have tried a workaround. The IRS says, haha, no, you cannot do that. So it will be interesting to see how that plays out over the next 6 months. But right now the cap is $10,000 between property taxes, state taxes, and ad valorem taxes for your Schedule A deduction.
So you're saying you won't pay more than 10?
So let's,
Is that what you're saying?
no, I'm saying, let's say you pay $20,000, you can only take $10,000 as a itemized deduction piece. So I paid $20,000 between my state taxes and my property, but it's capped at $10,000 is all I can take as a deduction on Schedule A. So it's capping it, which is why it's a big deal because a lot of people do spend 20 or more on all those things. So, and then, you know, there's vacation home, property taxes that come into play, and, you know, there's a lot of different things going on. So it'll be interesting to see how that pays
So
out.
this doesn't benefit individuals as much if they're paying a lot of
Yes.
taxes.
So in states where they don't have state taxes, it potentially has a better beneficial because the standard deduction has gone up so much and they were having a harder time reaching that because they didn't have state taxes. So in Florida, there's no state taxes, so you don't have like a $6,000 state tax bill, but now you have these higher itemized deductions so you can offset. So mortgage interest, if you're getting a new home loan, your indebtedness can only be $750,000 to take your mortgage interest deduction. So this means if you take out a loan for $1 million, or you have two homes and it equals over $1 million, which is a lot of times what will happen because you'll have a vacation home and your primary home is increased in value and whatnot. You can only take $750,000 where before it was $1 million. So they dropped that down, $250,000. There, if you have a home loan, like an equity, second mortgage, and any of those lines, you can no longer take the interest deduction on that, which is a bummer for a lot of people. Charitable contributions. So if you donated $100, you used to get $50 to take as a deduction. Now it's $60 because it's up to 60% for cash donation.
Charitable contribution.
So any nonprofit, it has to be a legitimate nonprofit. GoFundMe, yep. GoFundMe does not count. A lot of people think so.
I always thought it was 100%.
I did too.
It's not. No, it's not. Isn't it that fun?
Well, question on that.
Yes.
Though, was there not a provision where you could do a charitable contribution and deduct it even if you didn't itemize?
There is some provisions that are coming out, and the state of Minnesota also allows you to deduct charitable contributions even if you don't itemize. So there are some provisions on that. So a big bummer for W-2 employee on their individual return is no employer non-reimbursed business expenses. So if you're doing a bunch of mileage traveling between office locations, out to clients, and your employer's not reimbursing you, you can no longer take that deduction. That has completely gone away. That includes the tax prep fee, anything that was in that 2% miscellaneous deduction on the bottom of your Schedule A. They think they'll start seeing more 1099s, more LLC setup in light of that, because a lot of employees that the employer's not reimbursing and they're doing these things on the side are probably more of a statutory employee, which it would go on your Schedule C instead of as W-2 wages. So we'll see. No personal casualty losses. If you have a fire at your house and you lose everything, there used to be a deduction you could take on Schedule A. Now it's only if it's a federally declared disaster area. So Hurricane Irma, for example, you could take that. Or tornado, or something like that. Otherwise, you can't take it. I don't have that. Oh, that's a different thing. So AMT, we're just going to touch base on a little on this. But the exemptions has increased, so less people, in theory, should be subject to AMT than they were last year. So that's kind of exciting. No Roth conversion reversals. So you can convert to a Roth IRA, but you cannot reverse it to avoid the tax hit. That was a strategy that various people use to avoid tax hit, and that they've closed that kind of loophole. Alimony, this is a big change, but it doesn't take into effect until divorce is finalized after December 31st, 2018. But if you modify your divorce agreement or you get a divorce after that time frame, the alimony is no longer income to the one spouse and an expense to the other spouse. Its category is more like child support. It's just not a non-taxable item. So good, bad, or indifferent, that will affect people in different ways on how that works.
So was a deduction for the one paying?
Yep, it was a deduction
for the other one.
Yes, and then income for the one that was receiving.
And now
it's gone. My thought behind that is a lot of times there was discussion on what was really child support versus alimony, and so there was a lot of questions, and this just kind of it's all in one. I mean, it's your ex is giving you money, and it's like just changing hands, so there shouldn't be an expense for it and an income for it. So
they're just getting rid of that as a tax.
Yep, but it has to be finalized after that date. So if your divorce finalized today, then you would still have to take the income and expense. The Affordable Care Act, everybody's favorite discussion, no top point. The penalty goes to 0 in 2019, so you still need to have insurance in 18 to avoid the penalty, but it goes to 0. The requirement to have health insurance will still exist. However, the penalty will be 0, so the incentive won't be there to stay. There are lots of proposals on what they're going to do instead of that, but nothing is seeming to come out of the place because the marketplace has gotten so diminished on your choices on what you can get anyway. So moving expenses. So Carrie just moved. This is a big bummer. No moving expenses deduction anymore, unless you're in the military. So should have moved before 12/31/17 in order for, you did avoid the big snowstorm at least though. Yeah. We moved in April, the week after we got that last snowstorm. So, so that is a bummer and a big change. Kitty tax, so it used to be fun kitty tax stuff. Now they're just going to tax kitties and that's usually for kids that have investments at trust rates to make it more simplified. Professional gamblers, this is kind of interesting if anybody's a professional gambler. You can only have your gambling losses out-of-pocket expenses limited to your winnings. If you were a professional gambler, you used to be able to get around the loophole, but now they've kind of closed that. And gambling losses are no longer allowed on Schedule A because of the no miscellaneous deductions. So you have to be a professional gambler to even get expenses against gambling winnings. So if you're going over to Treasure Island, it's just something to keep in mind.
You used to be able to deduct your losses, is that it?
If you itemized on Schedule A. So most people deduct it. You can't exceed what you win in your deductions on Schedule A either. So if you win $1,000, the most that you could have paid in for losses would be $1,000. So yeah. Another bummer is the college athletic seats. So if you wanted to buy Gopher tickets, you used to be able to take part of it as a charitable donation. I can't. It's no longer considered any sort of charitable donation. Golfing tournaments are also in this category, which it's, yes, and so we'll get to the entertainment in a little bit. Yes, I know.
So for those like places that try and do like a fundraiser and do a golf event.
Yes, so now you would have to do, like, the ticket price would to get around that, you would do a separate ticket for like $20, and then you would encourage everybody to donate $80. So like the ticket used to be $100, so then they could get it because they could donate the $80, and the ticket price would only be the $20. But you couldn't force them to do it and have it be included and say this portion of your ticket is donation and this portion is. So it will change that structure a little bit, which is a bummer for nonprofits. And a bummer for businesses and individuals that were enjoying some of the benefit of the donation. Because that's what it was a fundraiser for those types of things. Not saying that you can't do any of the stuff, the tax deduction changes. Student loan forgiveness. If you die or you're permanently disabled and your student loan is forgiven, it's not considered income, which is great. That benefit needs to be done. So, is the pizza here yet? Nick, did it come?
What is it? What's going on with the vacation homes?
So if you don't rent if you rent your house out for like an Airbnb, and you rent it for less than 14 days, you don't have to take that as income and expenses. It's when you hit over 14 days, you have to do it. Also, if you are not renting out your vacation home, so let's say you have a cabin and you call it a vacation home, but you had no rentals that year, you have to qualify it as a personal residence in that year that you're not renting it out, which that never used to be the case. And this is a big bummer because let's say you're not renting it out and you have property taxes you paid. Now you go back to that limitation of only spending the $10,000 on your itemized deduction. So it all kind of cascades. So just try to rent it out for a day or two, or over 2 weeks would be ideal. So,
but it needs to be rented out over 15.
Yes, in order to have it count for vacation home rental. So like a lot of people rented out their houses for the Super Bowl for like a week or two. And if it was under the 15 days, then you don't have to include that, which is nice. So there's
income. You don't include that as income.
Nope. Right. That's where the IRS kind of draws the line. So, all right, we will talk about businesses. I'm guessing they called me. I'm going to just take a second to see if they did call me. I'm really sorry. I know.
Okay.
It's just,
We understand. That's the worst. You're like speaker and 100 people and I feel for her. I got you. One time when she was Kate. Yes. Nice to meet you. What do you do?
Yeah. Finally.
It's not financial question. Yeah, I get it. Well, the tax.
It's not my. Yeah. Not right.
Yeah.
That's all. I mean, my heart is been dysfunctional. Got to figure out this side. So, you don't live in that place. Yeah, but you need to at least have that track.
There we go.
And all these changes.
You get to go visit them too? No, and there's Kelly and Carrie, so I'm an attorney and I was going to rest on this because I have any questions and it's just so hard to keep straight. Last year, the proposed legislation, so I was watching all the proposed legislation, like what, and kind of keeping some of those numbers and figures.
It's gonna launch me into space.
Actually implemented what's different and it just becomes. And then, but you can read it. Yeah, because that's, how can I tell my clients? Yeah, what kind of law do you practice? I do.
I'm not gonna touch that lever.
And are you, which location are you? So my primary base is the East Bloomington one here by the airport. Oh my gosh. Yeah, because you
gotta push it.
Oh my gosh,
Push down
this is like quite the collision of, I guess
Yeah,
I didn't see what you look like.
I've been working out.
Yours is better than that.
Yeah, I didn't either, but actually it just hit me, I was like, wow, great, that's okay.
Final write
No,
off
that's
is
okay.
drawn,
So
not
remember,
written.
you had, like, you had some scheduling,
drawn,
you
not
had a
written.
client
Yeah,
that needed to
yep.
schedule as I recall, and so, no, I totally get it, and I'll
look at your calendar for your own and never went back.
Okay, let's do that.
Actually, it's probably.
I'm just gonna grab, before I can start back up, I'm gonna grab my card so that when it comes, then they can pay for it, and then we can continue.
How was your lunch thing? Somewhere going, it's busy, it sounds like.
Yeah, it's been between trying to take a little bit of time to be able to enjoy that time with them.
Yeah.
Two of them
All right, well, exciting stuff here. Next time I will triple check. I did call at 11:45 when I was supposed to be here, and they said, oh, we had it for noon. And then, so I thought we were all set. So again, sincere apologies.
No worries. No worries.
So, but I'm hungry. I really like bread. So, all right, so we're going to talk about C corporations for just a minute. Is anyone in here a C corporation? No. So we're just going to talk about it for just a minute, because you have a question about it.
No, I think I am, but my brain isn't. I can't look at tables or.
So if you're a C corporation, you're now taxed at a 21% flat tax rate, no matter what your level is. So if you were a C corporation that only had like $10,000 in income in a year, you don't benefit from this because you would have been at a 10% bracket rate. But it's a flat tax, so there's no question on where you're going to be on your taxes. A lot of people that are S corporations or partnerships ask me about transferring to a C corporation because of this 21%. Well, you still don't avoid the double taxation. So not only do you get the 21% on, but there's something beneficial to pass through. We'll get there in just a minute. So you have to pay the 21% tax, and you as a closely held, company, you want to take your money out, you have to take it out as a dividend. So then you're taxed at dividend rates for the money that's yours that you're taking out. So there's still that. There's also conversion taxes when you're converting from one type of entity to another. So just things to consider. If you're considering something like that, I would recommend to sit down with your advisor to run the numbers to see if it really does make sense. Because if you add it up, depending on your tax bracket, you're paying a lot more typically for most of the small businesses that I work with. So, but bonus, there's going to be this qualified business income deduction we're going to talk about in a minute for pass-throughs. So, and that's what most of the businesses that I work with are, and that's what a lot of businesses are becoming these days, unless you're, a publicly traded company, and then you're in a different category, different discussion. So, entertainment and meals. Entertainment is no longer deductible. Nathan is really loving this seminar. So anything you spent from January till now in entertainment is not deductible. However, you will like this. I'm encouraging my clients to meet with marketing advisors to discuss more advertising opportunities. So instead of just buying the suite to give the tickets to, for the Wild Games, corporate would buy like a suite. I'm encouraging them to look at actual advertising opportunities with the Minnesota Wild, because then you can take a deduction that way. So get with your marketing and advisor and really look at advertising, because that is still deductible and it's 100% deductible. Whereas entertainment was only ever 50% deductible. So let's say you did buy those suite tickets, it would only have been, you know, like you spend, let's say $1,000 for one game or something. You would only get the $500 of benefit. So this is a big bummer. And then there's some discussions on meals. Meals, if you used to host an office party, it used to be 100% like office lunch more. Like you buy everybody at the office lunch for their convenience, you know, so that like during tax time we do it a lot because it's easier to just have stuff there for people to eat, and then we can work longer days. That's only 50% deductible now, where it used to be 100% deductible. So that is a big change for some businesses.
So that's any kind of meals that are business related.
With the exception of, I have this chart to make sure that I, so I have this chart. I'll get on the next slide, and so I'll go over it in detail. There's an exception for like the ribbon cuttings or the open houses or whatever. There are some exceptions where you can still get the 100%. But majority of the time it's 50% now for employee. So like, you can still take meals. Meals is still deductible, but it still meets the same scrutiny that it met before, which some people just kind of, entertainment / meal, it was fine. It was going in the same bucket. So one of the things I really encourage my small businesses to do is, one, make sure they are tracking meals and entertainment and separately now. So you have 2 accounts now. Go through your account, you know, or have your bookkeeper go through from here, you know, for the year. Because that is an area that the IRS scrutinizes more than others, even though it's at 50%. So, you know, you don't want to have that be hugely high any given day. Like if every day you have Byerly's on your, you know, well, that's probably not 100% business related. And the threshold and the standard for business is still what is ordinary and necessary for you to run your business. So any expense that you have as a business owner, is it ordinary and necessary to run the business is the standard. Is it ordinary and necessary for me to have printed flyers and have marketing materials? Absolutely, you know, for me to have a business. So that's like a threshold, the standard. Was it necessary for me to order the pizza? Maybe not, maybe. That would be, you know, you just start having to think about perspective. I always think about it as I am Bill Gates for my company. So anything that is ordinary necessary for Microsoft to pay Bill Gates would be ordinary necessary for my company to pay me. That's a whole nother discussion on a different day. So there's a chart in here, and I can email you guys the slides too if you'd like, because you can blow them up. But it has what was allowed before and what was allowed now. So for example, we just talked about 50% expenses for business-related meals and entertainment used to just be one category. Now it's meals are still 50%, but there's no deduction for entertainment. You used to be able to deduct 100% of the meals provided to employee for convenience of employer. Now it's limited to 50%. If you pay for a meal and then you add it to the employee's W-2 or 1099, then you can deduct it. So, which I don't know why you do that. You can still deduct 100% of food, beverage, and entertainment that's available to general public. So that's where I was saying the exception for the open house, because the general public can come. It's not just employees.
Is that considered then almost like advertising because it's to whoever?
Yes. So then it was the 100% instead of the 50%. So if you have an office party and you're just inviting your employees versus you have the open house where you're inviting employees and general public, then that's where the 50% versus the 100% will come in. Does that make sense?
Yeah, and just to...
Yeah, go ahead.
I was gonna say, so I can still take all the clients to lunch and
Yes. Yep, that's still 50% deductible. Now, if you're taking yourself to lunch, they're drowning on that.
What if I have really good business conversations?
If you are a sole business owner and you're taking yourself out to lunch and you don't have anybody else there that you're talking business with, that's where they kind of draw the line. Because that would be a fringe benefit, and so then there would be different rules and regulations on it. So, great question, though.
So you had said maybe have a separate account for meals and entertainment, but it would more be just for the meals, the
Right.
business meals, and you wouldn't necessarily want your entertainment to be in that account.
That's what I mean. I apologize if I was unclear on that. Yes, you want, it used to be you combine the meals and entertainment into one account in your QuickBooks or your Peachtree or whatever you're using. Now you want to make sure you have separate accounts, and even within meals, or you want a separate account for like open house, you know, so then I'm just thinking about, you know, Office Center's open house as an example this week. They're having an event. That might, you want to have a separate account to make sure you're deducting it at 100%, because if it was in the meals account, you would only get the 50%. Your accountant's going to take your numbers at your end and not like digest them and be like, oh, okay, 50%. So,
I have a quick question
great.
regarding that. What if you have like quarterly management meetings, attorneys, CPAs come, and you have it catered? Is that, because it's a business meeting in-house?
So that would be more general public's invited, right? It's not just employees.
Okay.
So that's where the line is.
And it would be 100% deductible?
Yes.
So what if we buy our secretary lunch too, because she can't leave, because she has to man the, you know, the front while we're all in the meeting?
Because that would just be included with the meeting expense.
Now, would you classify that as meeting expense?
I would classify it as meeting expense rather than meals. Good question. I told you we'd like some stuff in here, just not all of it. Depreciation, this is kind of an exciting change. 100% bonus depreciation available through 1/1/2023. And you can use it on tangible personal property. And then section 179 went up to $1 million, and it includes roof, heating, ventilation, air conditioning, fire protection alarm systems, and security systems. That you used to not be able to take section 179 on. Section 179 basically means you could just take the expense in the year that you purchase it, whereas normal depreciation, typically for tax you use makers. It's over a period of, let's say, 5 years, 10 years, 27.5 years, depending on what it is. So I also recommend everybody kind of take a look and make sure they have a capitalization policy in place. There is a de minimis capitalization policy that the IRS has that we recommend for our clients to at least take a look at, where the threshold is $2,500. So anything over $2,500 would need to be capitalized. Under that threshold, it will be considered expensible in the first year. So that's something to look at.
What does that mean?
Depreciation or expense?
I mean, just like, can you give us a scenario
Yes.
of?
Yeah, so which piece of it can I help explain?
The section, what's available now, so.
Okay.
For example,
So let's say you have a building,
yeah, so this is still for business owners.
business owners, we're
So
still
this
talking
is-
business.
You have a building.
Or a renter, like let's say you have and as an individual, you have a Schedule E, so you have a rental, or you have a Schedule C, and you have a small, you know, sole proprietor businessship. This stuff is all available to you also. So a lot of times my property management companies or my clients that have rentals, they get a new air conditioner unit. Prior to the new law, you'd have to depreciate it over 27.5 years, the same as the building. Now you can take all the expense in the 1 year. Section 179 is limited to loss. So if you don't have a bunch of income, sometimes section 179 isn't the best benefit for you. And that's where bonus depreciation comes in. And there's no cap on how much you can take in bonus depreciation, where section 179 is capped. This is more for, you know, small business owners renovating their buildings,
Like
or whatever.
management people,
Or you have lots of different locations, or, you know, this location opened up this year, and we got new furniture, you know, those kinds of things. She can take section 179 on it this year, whereas last year she might not have been able to, for example. I mean,
it just doesn't apply to someone who's renting an office here.
Well, sure. If you are you buying furniture for your
Sure,
office
yeah,
here?
it could be, right?
Yep. So
So
then,
then you could deduct 100% of that this
yep,
year.
mhm,
Whereas-
absolutely.
Okay, so that's
Before-
very common, yeah, because we had to do, I think we had to do over 5 years before. didn't we?
Yep, it used to be, furniture and fixtures typically are either 5 or 7 years, depending on what type it is.
Okay,
Bonus depreciation in 2017, it was 50%. So you could take 50% in the first year, and then the rest of it would be over the 5 years.
You don't have to take a full depreciation because that can carry over there.
You don't have to do you don't have to take bonus, and you do not have to take section 175. And in fact, I have clients where we talk strategy on, okay, it makes more sense for you to take these expenses over 5 years, especially if you're financing it, and you're paying for it over 5 years. Sometimes that just makes more sense. But these options are available if you want to have a bigger loss in year 1.
so you could take it all in 1 year, or you could spread it out.
Yep, you could, yep.
Options.
Yeah, so there's more options, which is nice.
Can you split the two? Can you take section 179 to get to 0? So if you have $10,000 of the taxable income, you buy $20,000 in property, you can only take section 179 to the extent you have.
To the $10,000
taxable
income, right?
And so you can't take it below
So what-
0.
So what will happen is the $10,000, if you take it on the asset of $20,000, the $10,000 will carry over to the next year.
Okay, so you can't then go ahead and take bonus on top
No,
of that.
you can't
Okay,
do
so
a
you have to do
10
one or the two.
Yeah, you can't, it's not a mix and match.
Okay, so you're
Unless it's-
better off
okay,
taking
so-
bonus, because you can go below 0 on bonus.
Depends. It really depends. Sometimes it's better to carry over that expense to the next year because you're gonna have a bunch of income next year. So you just want to get to 0 this year. You don't want to be huge loss. You just want to be at 0. Let's say you're looking at buying a personal home. You don't want it this huge loss. You want to show, 0 or above 0. So there are different strategies that are involved in thinking about how to handle depreciation. So any other questions on depreciation before we go to the next one? Oh, all right. Automobiles, I put this as a separate category because in the past, if you as a business owner bought an automobile for the business, and you then 2 years later you bought another automobile for the business, your gain would be deferred because it was something called a like-kind exchange. So you have automobile for automobile, so it's basically the same asset, just a newer model. So you could defer the gain until you no longer had the automobile. Now they are not allowing like-kind exchanges. So you're gonna have to take the gain in the year of sale.
What do you mean gain though? Because don't automobiles depreciate, or am I thinking about that wrong?
Well, okay, they do depreciate. However, you're gonna take depreciation in the business each year. So year 1, you're gonna take, let's say you take section 179 on it, or you have a luxury automobile and there's certain limits. So the first year get $15,000 of depreciation on it, and the vehicle was $30,000. That $15,000 of depreciation that you took the expense, it's subject to recapture on gain. So
So if you sold it for 20,
yep.
so
So
that was your trade-in.
yep. So you'd have a loss on. So you bought it for 30.
Yep.
You sell it for 20. You have a loss on the actual vehicle itself, but you took $15,000 depreciation, so you have to add that
You
back.
have a $5,000 gain.
Yeah,
You have to basically.
Well, it's actually
Year you
a
sell it.
$10,000 loss and a $15,000 gain because it's two separate
A
types.
15,000 loss and a 5 gain, right? Is that what you mean?
Okay,
Or-
no, $10,000 loss because you bought it for 30 and you sold it for 20.
Oh, okay.
So you have a $10,000 loss on the
$15,000 of
asset.
depreciation.
Yep, and then the $15,000 gain
Separate.
would be on the depreciation, which is separate.
Okay,
Does that make sense?
I think so.
I talk
So
in
there's not a
tax, so
gain, so there's not necessarily a gain then, but I guess maybe not.
they're different types. We can run some numbers.
I'm just curious, yeah.
Yeah, no, and I
Sure, it's more.
and
than
I
you can get
obviously
into
like
right now, yeah.
see the pages on the tax return, and I want to point them out to you in in my head. So
Sure.
apologize for that.
No,
Yeah.
that's okay.
Like kind of exchange only automobiles, or did they change that?
So no like kind exchange except
anything?
for some real property that is not held primarily for sale. So an investment type property.
Oh.
There's some limited
So if you have
exceptions.
an apartment building and you want to sell that apartment building and
And get it-
exchange it for someone else, you have a different.
Yes, that is a great question. There are some loopholes on that.
Okay.
But basically, no 1031s.
Okay.
They killed
No
that whole.
1031.
Mhm. So they killed, I think I had that on one of these other pages. 1031 is only allowed for non-personal property exchanges. So it's very limited on what you can do 1031s.
What's the dates on that? Was there like a cutoff date?
I think it's 1/1/18, 12/31/17. And these rules primarily sunset in 2020. What did I put on the front? It's 20. Well, we can't even see it. It's 2023, 24, 25. However, there is currently a movement right now to make them permanent, and then they would have to create new laws to change them rather than sunsetting. What we were running into before, though, is every year or every 2 years they would say this is going to sunset, and then they'd have to do the extenders, and then government shut down, or whatever. So it's good that this is a period of 7, 8 years, 10 years, depending on what it was. But it could potentially still change. So.
Question?
Yes.
Question on it, because I actually have a client that's been in the process of doing 1031 exchange for real estate.
Is they working with somebody?
Well, that's what I need to call them, because I didn't know that, so that's why it was worth coming just for that, because I need to call them now.
I would just make sure that it's under the new rules. When clients do 1031 exchanges, I have them work with people that do 1031 exchanges. Yeah. I can do the accounting on it, but I want them to make sure that they're following all the rules and regulations, because there's specific things that you need to do and specific timeframes you need to find. So
you're saying those are no longer available if it's personal property?
Well, that's
so
real property.
Yeah. So if it's a real property, then it would be still available,
Oh.
but there might be some rules. So it's just something to look into. Okay. We'll look at it. I don't want to misspeak either on that, but since it's real property, then there is an exception, a loophole. So the next slide talks about net operating losses. You used to carry back net operating losses 2 years. So let's say you had a big loss in 2017. You could bring it back to 2016 and 15 if you had income in those years and you wanted to use the loss against those income, and you would file a form to do that, and then you could get a refund as long as you filed within the 3 years since that you filed the tax return, because after that then the IRS just keeps your money. So now you are no longer allowed to carry it back. You can only carry forward, and NOLs are only allowed up to 80% of your taxable income in any given year. So you used to be able to bring your taxable income down to 0, not anymore. Now it's 80%. However, then you still have your standard deductions and your potentially some credits and stuff. So it's not saying that you are going to for sure owe tax, but it gives it a little bit more room for taxes to be collected on people that have big NOLs. Any other questions on NOLs? Okay. Domestic activities production. If that applied to you, it's no longer available. Mostly manufacturing, so domestic, so U.S. manufacturing type. There used to be a availability for reducing your taxes with having that. That's not available starting 1/1/18. Yeah. So I have gone through my clients. Well, it's engineering, and there's some other different domestic activities categories. So we've gone through, we data mined everybody that got that last year and are connecting with them and being like, okay, so this isn't available, but now most of them are S corps or partnerships. So now you can do this QBI instead, which might be more beneficial. And we're going to get to that in a minute. Cash basis. Basically, as long as it makes sense for you to use cash basis accounting, you can use cash basic accounting. It used to be a $10 million gross receipts test. Now they bumped it up to $25 million, and they always have accepted it for service industries. So you can use it as long, or not service, I'm sorry, not S corporation. All right, okay. C corporations always had to follow these regulations, but if you're not a C corporation, you don't have to follow these regulations. I'm going to take a sip of water. Okay, so I'm going to rewind one more time. if you are a C corporation and you have over $25 million gross receipts, which there's a look back period on that, then you must use accrual basis of accounting. But if you're not, then you can use cash basis. So basically the IRS a few years ago, maybe it was even like 10, came out and said, you know, cash basis makes a lot of sense for small businesses. So anything under $10 million, we don't care, you can be cash. If you are on accrual basis and you're considering moving to cash, you have to remember there is still a special form and there are potentially some tax consequences on changing methods of accounting or vice versa. So it's good fun.
It doesn't apply to S corps, though, does it? You're saying specifically C corps for this?
C corps, yes.
Yeah.
So if you're an S corp, it doesn't matter. Same with inventory. Not that they bumped that to $25 million. So if you have, does anyone have inventory they track? Like, so we're gonna kind of gloss over this, but basically, they're going to allow you, instead of having to capitalize it in inventory and then expensing it when it's sold, just take the expense when you buy it. So that will be nice for some contractors or that's what I have an air conditioning company that this will be nice for, because we won't have to do the 263A of making regular expenses inventory anymore.
So they buy their widget and then immediately be able to expense it.
Yep.
What if they sold it for lesser than? You know what I mean?
Well, if they're, it depends on what kind of accounting. So this will be a change that won't happen quickly because it's not the GAAP approved method either. So, but it's nice for not having to do, there's a specific calculation on your tax return. It's called the 263A calculation, where you take regular expenses, general administration, and you capitalize them as inventory. And you don't have to do that anymore if you're under 25 million. So that's the biggest bonus piece of it. So if you have a case against you for sexual harassment, you can no longer take that as an expense. It's a non-deductible expense. It's no different than an IRS penalty. You can't just, you can put it on your P&L, but you can't take it for a tax loss. So
How is that if someone gets a payment from it? That's not taxable.
no, not taxable income either. And they have gone out on a limb and said, even if a non-disclosure is involved in the sexual harassment case, you still can't take the expense. So I'm not sure how that's going to work, because if it's not disclosed what the case is about, how you would know one way or the other, but on your honor can't be expensed. So attorney's fees can be very pricey in those types of situations, and they're no longer expensible. So. All right, we're going to talk about the qualified business income deduction. This is the fun part.
Oh boy.
This is the new deduction. This is the 20% pass-through deduction for basically anybody that gets either a K1 or as a Schedule C, Schedule E. They came out and said, okay, so now we've made C Corps 21%. Now we got to do something for anybody that's not a C Corp, basically. So it's going to reduce your taxable income, and it's even available if you take the standard deduction. It's not like a tax on to Schedule A, which is good. The phase-out threshold starts at 157 and 315, so single, married filing joint. There is a really not fun catch with this when you're in a service-based industry. And we'll talk about that in a minute. Trusts and estates also can have this deduction. So unlike sometimes when you buy a building and you're renting it out, you put it in a trust, and you're also, they will have it because you're getting the K1 through the trust. So
What's a service-based industry, or how do they classify that?
do I have it in here?
Like a CPA, are you?
I am a service-based industry. I am specifically excluded. I don't think I put the definition in here because it makes me mad. So who is eligible for QBI? Well, let's come back to that in just a minute. So in general, sole proprietors, Schedule Cs, sole owners of rental real estate, S corporation owners, partnership owners, and any pass-through entities
are
excluded?
yes, are included for QBI. So anybody that meets those potentially has the ability to take this
But
deduction.
not service.
Well, you can take it
Oh.
as service, but there's caps on it. So that's what's,
Oh, I see. So those are the caps for service-based industries.
right. So well, yes and no. So we'll talk
Layers.
about, yeah.
Layers.
We'll get to that in just a second. I'm just gonna kind of, okay, so qualified business income, trade or business. So it's trade or business qualified income. So, right now, if you have a medical marijuana business or a marijuana business, you don't qualify for this QBI. But right now, you don't qualify for any expenses either. The government only wants you to record your income. So that's, if that applies to you, please speak with a professional because there's specific rules that need to be followed. But any qualified, so pretty much any trade or business, as long as it's a legal activity, legal, not illegal.
What's deductible? I mean, I'm just not following. 20% of your income not
Yep, so
reported on.
I'm just talking about what is the qualified business income that would count. So, in order for you to have it count as qualified business income, it has to be a profit motive, continuous and regular activity that has begun. So like if you're starting up your company, but like let's say you're movie theater and you're not actually open for business until January of the next year, you can't get the qualified business income deduction in the prior year. And then sales of goods of services. So as soon as you've made your first sale, then you can qualify for it. So you wouldn't be able to take QBI if it's a hobby, triple net lease, vacant land, or any unusual activities or illegal activities. So, but everybody else really qualifies for this deduction. So the general classifications and limitations are, so it depends on if you're married filing joint or you're single, and there's head of household requirements that somewhat close to single, or maybe even exactly have to look. So if you're adjusted gross income, so that we're going to talk about two different things right now. Qualified business income, so that's what's coming from the business. And then your adjusted gross income. Adjusted gross income is what's always been on your tax returns. It's your W-2 wages plus your K-1 plus anything else, whatever. Subtract some page 1 deductions, gets you to at the bottom of page 1 of the 1040 is adjusted gross income, and it's a number. And that's what the IRS tends to use for thresholds for a variety of things, including this deduction. So your business isn't what's really driving this, how much you can take of this deduction. It's your personal income. So let's say your spouse makes really good money and whatever else they do, then you might be limited on your deduction on your personal return. If you're a non-service-based industry or your service-based industry and your adjusted gross income is under 315 or 157.5, depending on married filing joint or single, you can absolutely take the 20% deduction and that's 20% of your qualified business income. So
I'm an S corp and I have payroll. Is that the amount of profit above my payroll?
No, payroll.
Small income from my payroll.
Okay, so if you are a partnership, the guaranteed payments do not qualify as qualified business income. But if you are an S corp and it's payroll, then it's included because it's qualified business income related. So that is a good question because it does affect people in a little bit different way. And it will affect, if your AGI becomes over these thresholds, how much you can take. So if you're in a service-based industry and you exceed the 315 or the 157.5, your qualified business income deduction starts phasing out to 0 if you're over 415 and 207,500, it's 50%. And then you get no deduction. So there's going to be a lot of strategies, a lot of breaking out, because some people own both service and non-service-based industries. So there's going to be a lot of discussion on how that calculation works, how they combine. I've taken a ridiculous amount of seminars on this, and nobody has the same answer on how that's gonna work. I have clients who have like 5 LLCs that flow into one LLC that's like, let's say, a property management type company, and they're, ones underneath. Well, the property management type company might be considered service-based industry. So then, is all of the disregarded entities also a service-based industry, even though they're rental? Maybe, maybe not, depends on who you talk to. So there's still a lot of clarification needed on what that is. So let's talk about service-based industry. So CPAs, chiropractors, investment attorneys. So pretty much everybody in this room. Paychecks, though, I think might be on the line. I know. Well, your restaurant business owners wouldn't.
Yep.
They would be not service-based industry.
You'd think that was a service industry.
Well, but they have a product of pizza that they are selling, or a product of whatever. But yes, they're providing services, but they have inventory and they're selling something. So that's
considered more retail.
Yeah.
Not service.
Right.
It's basically anyone who doesn't have a cost of goods sold.
Essentially, yes. That's a great way of.
Manicurists, hairstylists, anyone who is just your service.
But they listed out specific industries, including attorneys and CPA. Well, actually, it says accounting. It doesn't say CPA. So then there's some discussion on whether what's the definition of accounting, right? So there's going to be more clarification coming out about this because of all the different questions that could come out. I have clients who are like, I do not feel I'm a service. I don't, yeah. So we'll have to, we need more guidance, it really is what it is. But right now, taking the conservative approach of anybody that you kind of think might be service is service. Engineers are excluded. They're considered non-service for this. And architects specifically excluded them. At one point, they were not going to give service-based industries any deductions because they took away the domestics activities production, and then they put this in. So they were thinking this kind of replaces that. But so, yes, we get something, yay, but there's all sorts of interesting rules.
So for engineers and architects, since they're considered non-service, they still have a deduction on it.
Yes, however, now the deduction becomes a little bit more complicated to calculate once you hit over the thresholds. Once you hit over the thresholds for your personal adjusted gross income, again, this is not the qualified business income of the business, then it comes into play on how much property you have and how much W-2 you pay out, and a very fun calculation. So if you're over those thresholds, or you think you're going to be over those thresholds, you need to get with your accountant and figure out either how to go below the thresholds. Great opportunity for investment advisors. Time for retirement plan expenses to go way up. I think that's the point, because I can talk about it, but I have a totally different presentation about how to get detail and how to calculate into that. So,
Can you explain what you just said?
So once,
Retirement.
yeah, we're going to encourage clients, if they're in this AGI phase outs, we're going to encourage them to speak with investment advisors about making larger retirement payments, because then the AGI, or the income from the business, will go down because of the retirement expense, and so then they might qualify for stuff.
We have a business owner.
Business owners,
Okay,
yep.
Now, this is on the personal tax return form?
Yes, it will be. Well, it'll have to come through on the K1 somehow. We haven't released how that's going to work. But it's calculated on your 1040.
Okay.
Because it's driven by your adjusted gross income as you as an individual.
So basically take 20% of the business income, as long as you're under the AGI threshold, and then whatever your marginal tax rate is applied.
Right.
So I get a new deduction.
Yes.
Thanks.
Well, a lot of people will.
Thanks, it took away the mortgage
Yeah, I was
interest
gonna say,
deduction for me, but this will be worth more.
sole proprietors see all of, are there still the itemized deductions for businesses?
Yes, so this is totally outside of the Schedule A itemized deduction or
Okay.
any other deduction. This is a special deduction calculated specially. And I'm just gonna go through this last slide and I can answer more questions if you want, but so just the basics is the deduction itself will not exceed combined QBI or 20% times taxable income less capital gains. So again, it's a little complicated on how that works, on how the calculation works. And again, I'm happy to talk or run numbers with anybody that wants to run numbers or their accountant isn't wanting to run numbers, and go through it and kind of figure it out, because it's a case-by-case situation. And if your AGI is under the 315 or 157.5, then it's an easy calculation. It's 20%, you know. But once you start going into the next phases, it's industry-based and how much your W-2s are and how much property you have, and it's a fun thing for me because I'm learning something completely new and doing things that in a little bit different way. Creativity and planning is going to come, and you'll see how it plays out. More guidance is needed. So, but basically that's what I had to present today. And then I have a prize. Everybody put their card in because I put the substitute card in there. All right, Carrie, I'm gonna. This is a prize. It's a water bottle, some wipes. There's a USB drive in there, and some hand sanitizer. I'm gonna mix the cards up. You're not gonna look, and then you're gonna one.
There's lots of texture on it.
Okay, yeah, you're close. There's one with lots of texture. Hey, there you go. You got the water bottle. Thanks, Nathan. And then I have some letter openers. There's some pens and pencils and other like materials, you know, reading.
Thanks, Jerry.
I know everybody feels a little brain fogged right now because it's it's a lot, and it's a lot of changes, and it's things that you're not thinking about, and you're like, oh, maybe that does apply to me. A lot of, you know, I probably should look at my withholding right now, even as an individual, because the withholding tables changed and they're taking less out per paycheck. So you're getting a bigger paycheck right now, but then you might owe more because they're taking out less now. So it will be very eye-opening to some people if they haven't started thinking about it for when we hit January. So if you have more questions, I'll be around. I'm hungry. They brought some stuff. Finally, they lost the order, and the guy that usually does the orders was on vacation, and he's like, I got back today, and
you know what, it's all good. Thank you so much for
of course.
presenting. One of the excuses that I missed part, but we are also going to have it attached to our YouTube channel so that if the information was great or you didn't catch it in your notes, you can go back and it will be posted as of tomorrow.
Awesome.
We'll send a link out next week on the This Week at Office Center page so that if anyone wants to see it, it's going to be there for you, and you can also link it to your page as well. And thank you so much for doing this. I know that there are so many people who have been asking for this. For the rest of you, Sandra, have you been here? Cassandra, have you been here before?
No.
This is your first time, and we're having our grand opening on Thursday. So if you would like, we're having food truck. It's going to be the Blue Coconut Hawaiian barbecue truck is going to be here. So everybody gets a certificate for a dinner. If you want to come in, like either pulled pork or chicken, or I think they have a vegetarian option as well. Lots of music and adult beverages and soft drinks. So please come and join us because we are really happy to be in Woodbury. So thank you so much. Thank you. Yeah.
And one other thing, we'll be taking social media headshots.
Yes, if anybody wants to take social media headshot, $25, Dan's doing that, but $25, that's right, I'm sorry. I lied. It was the best deal in town. I just took another one. Although I'm getting my hair cut tonight, so. Could you have timed it a little bit better, or maybe I should. I should watch the calendar
next week, right?
Yes, he's gonna be at Friday. We're doing happy hour at France. Everybody's invited at 3 o'clock. Bring your business cards, and you will be doing it that day as well. So if you need to have an extra day, although most of you look lovely, so your headshots would be good today. Okay.